The NASDAQ 100 index officially enters a bull market, and history suggests returns will at least double from here. Is that true? You're going to find out in this video. Make sure you hit that like button. Let's hop right into it. So on the chart here, I do have the 20% line from all-time highs. If I draw a price line, you can see that that's 20% down from all-time highs, and that's what constitutes a bear market. And it's the same thing on the way up for a bull market. So if you go 20% off the lows, you'll enter into a new bull market. Now, obviously here on tech, we have been down below, but from the lows, we are now officially inside of a bull market from a technical perspective. A lot of people are signaling that the bottom is in and that you should be buying stocks here for the long term. Obviously on the index, that's less likely the case compared to maybe specific stocks that have been beaten down and are at a severe discount where you should be buying for the long term. But as you can see here, the SPY has broken that downtrend and is forming a new uptrend. Same thing with tech. We broke above, rejected here, then broke above, and now we're retesting support and breaking up to the upside. We are approaching that 20% line from all-time highs. Now, I do expect that to be an area of defense for the bears. I think bears will step in and maybe we'll have a pushback down here towards 313 once we touch that 326, 327 level. Looking at small caps, same pattern here. Broke the downtrend and have come back and retested that. Obviously, small caps are the weakest here, and you can see we rejected once again off that 20% line back in February. So I do expect that level to act as resistance on tech as well as on SPY. We've been bouncing from that level. So a lot can happen in the next several weeks. We do have the FOMC meeting on May 2nd and 3rd. 3rd will be the release as well as the press conference. And then, of course, we have a lot going on with jobs, CPI, inflation. All of those things are being taken into consideration for overall market direction. Right now, I do think the market is mostly a scalping market. You can't really swing positions for all that long because the market is very reactive to whatever economic data comes out. And as you can see here right now, that for FOMC, it's about a coin flip whether or not they're going to keep rates the same or raise by 25 basis points. And as you can see here, this is the previous FOMC meeting rate increases, and we have been slowing down. We were doing 50 basis points, then in February we only did 25, and then March 25 again. Now, a lot has happened in the recent months beginning in this year, and obviously we had the bounce in the overall market from October. Jobs market has been extremely hot. In January, you can see here we had 517,000 non-farm new payrolls compared to 185 forecast, and even in March we still broke way above the forecast, and that has been the case pretty much all of last year. The jobs market is extremely hot. Unemployment is really low. The Fed is looking at all this data and saying, why can't we just lay some of you guys off, slow inflation down faster? Obviously, when unemployment is extremely low, it's more than likely that by the law of averages that it's going to go higher, and then eventually unemployment goes up, spending and demand falls, and then we have a recession. Now, to give you an idea of where I think things are headed, if we just take a quick glance at what happened back in 2020, obviously the Fed, the government, printed $5 to $6 trillion for consumers to sit at home. You could see it here, obviously, even on the chart. We printed a bunch of money. Consumers saved a lot of money. That money now, with the reopening, COVID is not really an issue anymore. Consumers have been spending their savings, and the market estimates that there's roughly 1.2 trillion of that original 5 trillion that's left in savings, and consumers are spending about 120 billion of that stockpile every single month. That would mean that we would run out of that excess demand, that excess savings by the end of this year, early next year. And so what's going to happen is everything that has driven price up over the last two years, and then with raising rates and reducing the balance sheet, once all of that demand that was printed runs out, then demand is going to fall, inflation will fall, and ideally the market will also fall and we'll have some sort of recession. The Fed is already predicting this to happen. I have here the dot plot on interest rates, and obviously during a recession, the Fed lowers rates to stimulate demand. And so you can see here, this is the Fed dot plot consensus, these blue circles. And you can see here that the Fed median is 4.25% in the end of this year, early January of 2024. So rates are already at 5%, and they expect them to continuously lower rates all through the year 2024. So demand's going to be falling. They're going to be lowering rates to stimulate demand. And so they're trying to achieve this sort of equation to land, like do a soft landing where they can slow down inflation, demand starts to slow, then they can lower rates with it to keep demand propped up, so then we don't have a severe recession. And so I'd probably agree with this. I think this is probably what will happen, is they'll have to lower rates at some point. And obviously that's going to be good for the market, but a lot of the rates changes all happen in a lagging way. So it's not going to be an immediate effect unless they start printing money. Now, on the subject of printing money, obviously we had the bailout of Silicon Valley Bank and Signature Bank not being a bailout. We all know that this was what we call stealth quantitative easing. And you can even see here on recent changes with the balance sheet, we've been doing this tightening, reducing the balance sheet to $8.3 trillion. And then in the last 2 weeks, we've printed over $400 billion to help save banks. And then now we're reducing the balance sheet again. So that was really a bridge for these banks to not go under and to ensure market stability, because of everyone doing bank runs, leaving regional banks. You can try to stop the contagion, and the market really did rally from this. The Fed did save the banking system. They printed money, they backstopped. Companies that had deposits in these banks were essentially insured from not, anything above $250,000. They're still able to get their deposits out, and a lot of these companies were able to continue operations. And you can see it just really lines up with where the market stopped. We printed money. Now the market wants to bounce again. We've erased about 50% of the quantitative tightening in this movement to the downside. And now we're probably going to come back up. And I think we're going to be around this 420, even 430 level potentially on the S&P 500. And I think that, we likely will continue this uptrend. Maybe we'll reject here around 415, 420. I do expect that range to trade. Maybe we even break above it for a period of time, but the Fed is still tightening. We are going to have inflation data coming up. Obviously, they printed more money. We'll see how that plays into it. And then, of course, the FOMC meeting after CPI, that's all going to be really important to see if we do try again for a move to the downside, which I do expect to happen at some point, because at the end of the day, they still are tightening. They're not printing money more than they already just did, but that's going to have to filter through the system, and then at some point we'll have another shift to the downside and the narrative will change again. But as for now, I am bullish. I think this 400 billion will have to play through the market, and then we'll see where it goes from there. Another interesting one, just before I leave you here on this video, is Apple. So Apple is now $2.6 trillion market cap. It's definitely not worth that much. I mean, anyone who looked at this on a weekly basis, you can see that, Apple has absorbed a lot of the government stimulus because of consumer demand, buying new iPhones, laptops, etc. And eventually that growth is going to fall, and Apple will surely fall as well. But for now, I still am bullish. I think this top trend line will be tested, and Apple owns a lot of the market. It's Apple and Microsoft now, the two largest. All the other ones have corrected quite a bit, Amazon, Google, etc. So I do expect Apple will be the driving force behind the moves, especially in the NASDAQ. I'm looking for a rejection here around 168, 167. And I think that's going to be a great spot to start to build a short position on Apple. I do think it'll come back to 157. But looking here at the volume profile over the last year, you can see this 147 area is the point of control. So I do expect a longer term price target around that 147 level, and even potentially lower depending on what's going on in the overall market as well as what the Fed is saying. So that's what I have for this video. Still bullish now. Expect some selling later on. If you've missed the dip on shares, I do think another opportunity will present itself. Most likely at the end of this year is probably when I'm going to start scaling into long positions, only buying shares. But for now, I think this market is mostly a scalper's market. And I hope you enjoyed this video. I'll see you in the next one. Peace.